Good day, Dr. Wei and my fellow friends. My name is Fung. Metric number is 299694. Today, I will explain about the effect of internal and external factors on earnings per share of Apple Inc. in United States from the year 2015 to the year 2024. First of all, the Apple's with $200 billion capital return program introduced in 2015 reflects a strong financial confidence through dividends and share buybacks. However, this strategy increasingly relies on debt financing, which creates financial risk. While share repurchase can boost earnings per share by reducing outstanding shares, they may also increase leverage, liquidity risk, and long-term financial pressure. This creates a trade-off between maximizing shareholder returns and maintaining financial stability. Therefore, this study examines how Apple's capital return strategy and related financial risk factors influence its earnings per share growth. Based on this issue, this study aims to achieve three main research objectives, which are to identify the internal factors that influence the earnings per share growth of Apple in the United States, to determine the external or macroeconomic factors that influence the earnings per share growth of Apple, and to examine the combined effect of internal and external factors on the earnings per share growth of Apple. Accordingly, this study seeks to answer the following research questions. Firstly, is there a significant relationship between Apple's earnings per share growth and internal factors? Is there a significant relationship between Apple's earnings per share growth and external or macroeconomic factors? And is there a significant relationship between earnings per share growth and the combined internal and external variables? Next, we move to the literature review. First of all, Liu and Olson shows that profitability indicators interact with financial structure and market value will affect the business stability. Pharma and Fresh also shows that the profitability and EPS simultaneously communicate investors about expected returns, altering perceived financial risk. Next, Barnes examined that the optimal liquidity levels boost the company performance, whereas excessive liquidity can impair returns. Then, O and Penman examined that the variation ratios help in predicting future earnings and connecting market perception with financial stability. For the R&D intensity, Leaf and Sogeres shows that financing R&D influences earnings volatility and influences financial stability. Barros proved that the relationship between macroeconomic growth and firm-level earnings potential is suggesting a long-term GDP growth aligns with firm growth and market performance. Pharma and Squidward also proved that if the company is unable to pass costs on to customers, the rising inflation can drop the profit margins by eroding real buying power and raising input prices. Lastly, Blanchard and Katz shows that where higher unemployment leads to reduced demand and output contraction will affect the corporate's profitability and EPS growth. Next, we move to the methodology. This study applies inferential statistical methods using Apple Inc. as a representative company in the US technology sector. The sample period covers 10 years from 2015 to 2024 based on annual financial statements and relevant macroeconomic data. Earnings per share growth is used as the dependent variable, while the independent variables are divided into internal and external factors. The analysis is conducted using ordinary least squares with multiple linear regression, and all the data are processed using SPSS version 26. Three regression models are developed where Model 1 examines internal factors, Model 2 examines external factors, and Model 3 combines both to identify the most influential determinants of EPS growth. Based on Model 3, the descriptive statistics show that earnings per share growth has an average growth of approximately 8%, but with high volatility indicating fluctuating earnings performance over the years. In terms of internal factors, Apple demonstrates strong profitability with high growth, operating and net margins. However, the high volatility in ROE suggests elevated financial risk to equity holders. The revenue growth and asset turnover indicate positive but unstable operational performance. The liquidity ratios show adequate short-term solvency through the current ratio, although the quick ratio below 1 reflects relatively tight liquidity conditions. The R&D intensity and operating expense ratios remain stable, indicating a consistent investment and cost management. From the external perspective, the moderate GDP growth and stable inflation and interest rates support earnings growth, while changes in market volatility and consumer confidence may contribute to EPS fluctuations. The correlation analysis reveals that revenue growth rate and GDP growth exhibit a strong positive relationships with earnings per share growth, indicating that the sales expansions and overall economic growth play a crucial role in driving EPS performance. There are several variables show moderate correlation, including operating and net profit margins, liquidity ratios, R&D intensity, and selected macroeconomic indicators. The negative correlation suggests that higher costs, tighter liquidity, and unfavorable economic conditions may suppress EPS growth. The other variables display a weak correlation that implying limited direct linear relationships with EPS growth. Therefore, regression analysis is necessary to further determine the most significant determinants. The ANOVA results confirm that Models 1 and Models 2 are statistically significant, meaning that both internal and external factors individually explain a meaningful portion of the variance in EPS growth. However, the Model 3, which combines internal and external factors, is not statistically significant. This may be due to multicollinearity or overlapping explanatory power, which reduce the ability of individual variables to show significance even though the overall model fit is reasonable. The model summary shows that Model 1, which includes only internal factors, has the highest explanatory power with an adjusted R square of 0.936 and a very strong positive relationship with EPS growth. Then, the Model 2, which uses external macroeconomic factors, also has a strong R value and adjusted R square of 0.907. The Model 3, which combines internal and external variables, shows a strong R value but a lower adjusted R square of 0.544. This indicates that while both internal and external factors jointly influence EPS growth, the explanatory power of the combined model is lower than the individual models due to overlapping effects. Looking at the regression coefficients, the internal factors such as revenue growth, gross margin, net profit margin, and EV/EBITDA significantly influence EPS growth. This indicates that the Apple's operational performance and efficiency are critical determinants of earnings growth. The external variables, including inflation, interest rate, unemployment, and market volatility, are not significant individually. This suggesting that the macroeconomic factors alone do not have a direct impact on EPS growth during the sample period. In the combined model, there are no single variable is significant due to overlapping explanatory power, which is common in models that include both firm-specific and macroeconomic indicators as internal performance and external conditions often interact to determine the earnings outcomes. In conclusion, the Apple's earnings per share growth is influenced by a combination of internal operational efficiency and macroeconomic conditions. The strongest drivers are revenue growth rate and GDP growth, which reflect the company's performance during periods of economic contraction and recovery. Apple's high gross margins and efficient operating expense ratios allow the company to convert revenue into shareholders' value effectively. However, the company's $200 billion capital return program, including dividends and share buybacks, introduce a long-term financial risk. While share repurchases then can artificially boost EPS, they also increase debt levels and liquidity strain. Apple remains resilient due to its strong profitability and well-guarded ecosystem, but it is sensitive to macroeconomic shocks such as GDP contraction or changes in consumer confidence. Based on these findings, it is recommended that Apple continues balancing aggressive shareholder returns with conservative liquidity management, monitoring macroeconomic risk and maintaining its innovative edge will help sustain long-term profitability while managing financial risk. Ultimately, effective financial risk management requires aligning operational efficiency with global economic realities to protect shareholder value. That's all from my presentation. Thank you.